Okay, thank you guys for joining. I'm doing this now as a recording, not live, just because it's a little bit easier with everyone's schedule. I know a lot of people haven't been able to attend the webinars, so for that reason, we're just gonna keep it like this for now, with school starting and all of that. But if you guys do have any questions about the video, please ask in the Slack, direct message me or ask in the general chat. Don't be afraid to ever ask any questions. Ian and I are fully, um, we can help anything. We're fully happy to help. So don't worry about that. So if you do have questions, you can ask us in the general chat or direct message us. And from that, we're just gonna get started right away. So our thing today was going to be about investment risk models. This is webinar 3 of summer session 2. In terms of risk models, we're going to cover a few things. Some models, some simple ones like the CAPM. We're also going to look at bonds, notes, and bills, and then discount rates and the hurdle rate, and finally something else at the end. So we'll just get started right away. All right. So, all right. So a lot of you guys, you probably have used or you're familiar with the term risk, of course. So risk by definition is a situation involving exposure to danger. Okay. So exposure to danger, that can be anything from, I don't know, jumping off a cliff. I mean, that's exposing yourself to danger, stuff like that. Um, anything, it really can be anything when we think about risk. But when we think about financial risk, we think the possibility of losing money on an investment or business venture, right? So when you go into anything in finance, typically, you have a risk. Like, for example, a pizza shop. A pizza shop may sell, or someone may buy the pizza shop, and then let's just say that they spent all this money because they're expecting a return on the profits they would make from the pizza shop. But then for some reason, all the customers, they just stop going to the pizza shop. Let's say there's like a natural disaster or something. Then that's your risk, because really anything can happen when you do something in business. When that pizza shop, once it experiences that natural disaster, maybe customers aren't coming there. That person that just bought that pizza shop is now going to miss out on those profits because there are other things that affect a business besides from the quality of its goods and services, right? So there's things like stuff in the market that affects specifically businesses. When we think of market risk, stock market risk, the biggest things really are recessions, any period of like downturn, um, things like over leveraging, and also on not being like not having an understanding of the risk that can be present is another thing that is a risk. If you don't have an understanding of possibilities, you can really miss out. So your deviation of actual returns around an expected return, that's kind of like the more finance type of definition for risk. When we think about the deviation of actual returns around the expected return. So when you have an expected return, we'll get to how we can calculate that in a little bit. But your expected return is what you're expecting after you bought set entity. You're expecting what you should be getting. But the actual return is typically going to be a lot different, and almost all the time it's not going to be your expected return. What you actually get is something that could be better or it could be worse. So that's just kind of like that. What keeps people out of the market though is that risk. So like when you have the option, let's just go for this. So you have the option to be a waiter, or you have the option to be, let's see, let me think of a profession that makes a little bit less, a secretary, or you could be a waiter. So, as we know, typically secretaries, there are some exceptions, are typically paid like around a similar wage of somebody that works, with minimum wage. They make a little bit more than minimum wage, right? So at that point, they make more than minimum wage. So in my state, for example, it's $15 minimum, or yeah, it's $15 now in my state. And let's just say the secretary makes 20 an hour and they work 9 to 5, yada yada. But the other option that that person has is to be a waiter. Now, in this instance, that waiter is taking a risk because typically waiters, they what they get paid is less than minimum wage because they're expected to get tips. So that waiter is taking the risk to be a waiter because they know that potentially they could make an hourly wage that is greater than that $20 per hour that that secretary is making base. So when they take that risk, maybe for example, some night they get like $40 an hour. They take that risk because they understand there's a possibility that they can make more. It is risky to do that. It's hard to argue which ways to go. Obviously, it also depends on what you actually like doing. Some people might actually like being a secretary more than the money that and the risk that comes with being a waiter, So what keeps people on the market a lot is that risk. So like when you have the choice to be someone, I don't know, you can really be anything nowadays. You could be a hedge fund manager or you could be a teacher. What are you gonna choose? Is a lot of people are just going to choose to be a teacher. And that's not a bad thing. We need teachers. Some people are genuinely interested in teachers, but let's just say you don't have an opinion on how the job actually makes you feel. Let's say there's no like opinion on how the job makes you feel. Then, for example, being a teacher is going to be more safe for you because you understand that typically the government, there are some exceptions. Those are black swan events where you get knocked out of your position. But typically, teachers, they keep their job for yada yada amount of years, however many years they work, and they make that set wage. They typically don't go higher than a certain amount, like nothing crazy. Their salary's not exponential, they're linear, and then they stop at a certain point. But when you look at a hedge fund manager, they really have the chance to make $0 or they have the chance to make lots and lots of money, right? Because they are taking a lot of risk. They're taking that risk because they understand that they could make salaries up to millions and millions of dollars. They want to take that risk because that's how they are as a person. But a lot of people they can't withstand that risk, and that's why they choose not to be in the market. All right, so risk models. Risk models make the assumption that you are diversified. So when you are a diversified investor, that is the assumption that you are not holding all of your money in one entity or stock, right? Now, there are multiple risk models. This video is that's kind of our important part is looking at those risk models, but the one we're just going to cover today is the CAPM. Now, just looking at this sheet, we can see what different risks investments look like. A riskless investment, obviously, there's no risk of it. There's no return. You're not going to get any return in a riskless investment, or that return is very set. A high risk investment is a little bit different. The curve is a little bit different. And a low risk investment is going to look like something like this, where high risk areas are out here and high risk areas are here. And this is just how the numbers align. And that's just what you get for those curves, right? Now, differentiating between rewarded and unrewarded risk. So, risk that is specific to investment is firm specific risk, right? Now, this firm specific risk is what we consider when we're not looking at the stock market, right? Firms, they have other risks besides what the stock market carries. Now, let me go back a little bit before I go into that. So, when we think of the other what is the opposite of firm specific risk is market specific risk, right? Market specific risk is anything like a recession, fear of recession, changes in currencies, um, let's see, I'm trying to think of anything else. Changes in interest rates, anything like that. That's really market specific risk. And that risk is you have to consider it for every investment that you make in the country, and you have to consider those risks because they are part of the country, right? The company is within the country, so you have to consider that as one of your risk parts. But now this firm specific risk, when we think about the firm specific risk, we think of anything that actually affects the company. Now, what an example I'm thinking of right now is Tesla, right? When I think of Tesla, I think mostly of Elon Musk, of course, right? Elon Musk to me is a firm specific risk because very he's a very unpredictable person. We don't know what Elon Musk is going to say next. We don't know what he's going to do next. For example, he was just talking to Mr. Trump about the upcoming election. You know, doing something like that is kind of risky for your business. You don't want to really align with a party, especially when you're in a business like the EV market. I could see a little bit why he was doing it, just because Trump's not so much with the EV market right now. But taking risks like that is exposing yourself not only to, he's not only exposing himself to risk, but he's exposing every single shareholder to that risk as well of something going wrong because, I don't know, let's say Kamala Harris just doesn't want to affiliate with Mr. Trump anymore, or not Mr. Trump, but Elon Musk anymore. You know, things like that happen. And that's why that would be considered a firm specific risk. You know, you don't know what's going to happen when a CEO starts working with a potential presidential pick. You know what I mean? Um, Now another firm specific risk I'm just thinking is, let's see, really. It's a lot of the time it's with the people at the company, but it really can be anything. Anything like social media, social media might uh create these false views of your company, and that could be a firm specific risk for the company. You know, there are times, Bud Light, they had a problem with that. And there's a lot of different firm specific risks though. Also, I would say that things like what market is your company operating in? For example, let's say you're a mining company and uh let's say the commodity prices changes. That's a really big part of your business. It might not affect a company like Apple, but it's going to affect a mining business. So that's kind of a firm specific risk. So let's say the price of a commodity goes to like a very low level, it decreases a lot. That could be a risk because you can't get the same market price that you were expecting before, and investors have these expectations. All right. So from there, let's go down to these market risk models. So the CAPM is what we're going to be looking at today. It's really, so a lot of these models, they're not perfect. Obviously, you can't get a perfect I'm sorry, model, because you can't really predict the future. Predicting the future is hard, but we can make assumptions to make the best prediction possible, right? So the beta of asset relative to the market portfolio is your CAPM model from a regression. That's what we're going to be using today. The APM is the betas of assets relative to unspecified market factors. Multi-factor models, things like Fama French, betas of assets relative to specified macroeconomic factors, proxy models, equation relating returns to proxy variables. So some of these may seem more fancy, of course, but really at the end of the day, you can't predict the future perfectly. So it's best to just use the easier one. Adding more factors is a little bit riskier too. Considering all these factors may not be the perfect way to do it. So for now, we're just going to use the CAPM model. All right, so the CAPM is the oldest risk model. It makes assumptions that there is no transaction costs and no stocks are cheap or expensive. It is flawed, like I said, but it's very hard to explain the future. Now you can look here. This is the actual formula for it. So starting over here, we have the expected return on the investment. So that's our RI. Your risk-free rate is going to be on the right of the equal sign, and then you have to add the beta, which you times by this expected return of the market minus your risk-free rate again, right? So we can actually they have this website. It's pretty nice. It's a little calculator. They just make it a little bit simpler for you guys. So you can use that calculator. Just look up good calculators and then capital asset pricing model. Um, but on the calculator, you use your beta on Yahoo Finance. So let's look at this calculator. Well, let's pick a stock first. So let's do that. So we can really do anything. Let's see. Let's do a big company first. Google or Alphabet, whatever you call it now. Alphabet, we can do that. And then all we need from Yahoo Finance is that beta value. So 1.05. So we'll type that in and then we'll look for the risk-free rate. So we can find this risk-free rate by looking at the treasury, the 10-year. Hold on. I'm sorry. Let's see. All right, there we go. We're back. All right. Whoops. Let's see. All right. Just had to make sure I was still screen sharing. All right, good. So we can go. What was I gonna say? Yeah. Okay, so let's go back here. So, whoops. I'll keep this out. There we go. All right, go back here. So that risk-free rate is the 10-year yield for the treasury note. We'll talk in a second. I'll explain exactly what these treasury notes, the bonds, and the bills are. But how you can find this rate is just looking up Google. You just go 10-year treasury yield right here. And then we can go to CNBC. And here it is here. 3.863%. Okay. So we can do 3.863%. That is going to be your risk-free rate. I'll explain again why that is the risk-free rate. Look up the expected return. So we got that first. Or I'm sorry, we got the risk-free rate, and now we're going to look up the expected return. So we can do that just by looking up what is the expected return of the stock market. And looks like they have it around 6%. So that's your whole entire market. That's the expected return of the market. So we're going to put that there. And then from there, we'll calculate this and we get a expected return on the capital asset of around 6.11%, right? So that means that Google, because of that lower beta value and because of our risk-free rate, it means that Google right now it really doesn't have anything better than the actual market. It's trading really its whole movement as a whole as a company is really close to the actual market rate. So that means that 6%. 6.1% is really similar to the expected market return. And that we know that's true because I mean tech companies nowadays, Alphabet, Google, they have really high allocations in the S&P 500 and they typically move the market. So that's why. Now let's do a company that's more risky. So let's do a company like Intel. Oh, actually, they have still have a lower beta. Let's do here. Let's do a little bit different. We'll do one called Rocket Labs. All right. So this Rocket Labs, they have a beta value of 1.25. So let's change this. And now we'll calculate. Now we get a expected return on the capital S of around 6.53%. So that increases quite a bit, right? So from there, we understand that because of our market conditions, because of our beta value, the expected return on the stock is around 6.53% for Rocket Labs, right? So that's just kind of, the CAPM model. Me personally, I don't use risk models. I don't feel that any risk model is worth my time, but you guys can use these if you really want to. I just wanted to explain it because it is something that is important, but I typically don't use them. How I calculate my risk is a little bit different, and you guys have watched the videos about the discount rate. That's typically how I find my risk, and but we will go into that in a second. But you can use CAPM to find expected return if you want. Now, bonds, notes, and bills are actually no. Let's do yeah. We should definitely do this first. So the bonds, notes, and bills. So I covered this in let's see, webinar one of summer session one, but I covered it really shortly. I don't think I actually went to the Treasury Direct. And what exactly are bonds, notes, and bills? So we always hear news about bond prices, yada yada. There's bond traders, stuff like that. There's corporate bonds. So what are bonds? So there's corporate bonds and there's treasury bonds. Now, treasury bonds are typically the ones they're talking about. When we think of treasury bonds, they typically so how they work is they have a principal value that you pay. And then from there you get a value back, which is your expected, well, not your expected, but that's just the value of the bonds. That's just typically what they call the value of the bond, right? So you pay a principal and get the value of the bond back. So now what I mean is that during that period, so your principal is going to be your less than your value of the bond because during the period between when you buy the bond and when you get your money back, you are taking on risk, and that is investing in the United States. It is a little confusing. A lot of stuff in finance is confusing. I always say this, but what's happening is that when you are what you're doing is you're buying a bond, you're giving the US government almost like a loan. You're giving them money, and then in the future, they're going to give you money back, right? So this money is it's basically what happens is that they issue these bonds with a certain set value, right? Set percentage value. And then from there, you get that expected return back. That expected return is typically guaranteed because the US government is a very safe country. They have the triple A rating bonds, some other countries do too, but triple A bonds are the safest. The US, they're going to yield less than a country, for example, like Greece, where there's more expected risk. This all fits in with risk. So countries where things are not as stable, there's very high chance they default on their debt. And from there, you may not get your bond back. Um, but why these are important is that we use these as a part of our risk rate, right? When we when we figured out the free rate right here, this 3.862%, it changed 0.001%, but this is very stable. These changes only happen when the Federal Reserve releases their meeting notes and stuff like that and change the rates. And this just basically it gauges the economy. It it helps the economy during times of distress. They'll raise rates so that they can get more money into the pumping into the economy, and then from there they'll also drop it. Now, when we have low rates, that's going to be the best time. You know, See rates when they were down like to these levels in 2019, 2016, stuff like that. That's when your amount of business happening in the country is going to be the highest. And that's because companies take out debt with a set interest rate. You've probably heard these terms like firm specific risk and let's see, the discount rate, also trying to think of the other ones. Economics, a lot of these rates are talked about in the economics class, macroeconomics, but they don't always go, the teacher doesn't always go fully into it. And that's just kind of what it is though. Your 10-year treasury, that's that rate. And companies, they can lend out at this rate. So when this rate is lower, they're happier because they can get their debt cheaper. They can get their cash for a cheaper value and their debt's not as expensive, you know? So what I really mean by that is let's go into the Treasury Direct. So the Treasury Direct is where you can buy bonds. So anyone can buy bonds with through the Treasury Direct. You just have to be 18. Um, Now, like I was talking about before, that principal value and that what your expected return is, let's see. All right. So what were we looking at? We were looking at those 10-year notes. So let's look for that 10-year note. All right. So your 10-year note is right here. These 10-year notes were issued on 8/15/2024. The auction date was 8/7/2024, and they're expected to mature on 8/15/2020, or 2034. Um, Now these price for $100 is actually before I do that, I just want to go to a bill. It's a little bit easier to understand. All right. So let's look at this bill right here. So this treasury bill is similar to treasury bonds. Well, it's the similar thing. It just has a different time period. So bills, bonds, and notes, they are all similar. They just have different time periods from when they mature. They have a locked-in interest rate, so you know you will get it back typically. So you know you'll get it back typically, that amount back. So what happens is that you buy this 26-week bill. And then this is what you're going to pay. This is your principal. You pay 97.5885, right? And now what you're going to get back at the end of this period is $100 because that's the risk you have taken. This risk is guaranteed, and that's what you're guaranteed to get back is that $100. That's how bonds work. Now let's move over just down to discount rate or the hurdle rate. So take your country's interest rate and increase this rate by the risk you feel is present for the stock. So that will get you the discount rate, right? The discount rate is what it is for markets risk and that firm specific risk. So I was talking about Elon Musk, so that's like a firm specific risk. Things like social media affect the company, that's a firm specific risk. But a market risk is it's anything that I'm sorry, it's not anything. What the market specific risk is that 10-year treasury yield. So what you're going to do is you're going to add that 3.856%, and then you add what you think, what your assumption is for the form specific risk. I can't say this enough, but finance, you make assumptions. You don't know 100% all the time. So you have to make an assumption for what your firm specific risk is. So it really depends on what type of company you're analyzing. Something, for example, let's go back to the mining company. Let's say this mining company, it hasn't even started making money yet. Then from there, you have to add that risk present for a company that doesn't make any money. because they have nothing coming in for investors right now, you know. So discount rate is either the interest rate that the Federal Reserve charges banks for short-term loans, but for our definition, we use the rate used to discount future cash flows in a discounted cash flow analysis. All right, great. So that's kind of that. Just before we wrap this up, I just wanted to cover some books. So if you guys are interested in learning more about risk, not fully, I wouldn't say fully market risk, but one book you could read is The Black Swan by Nicholas Taleb. I've read this before. It's very good. I really like all of his books. You can see down here some of these. Actually, they don't know if fooled by randomness. Or no, they do. What I was looking for is Skin in the Game. So Skin in the Game is another really good book by Nicholas Taleb. But in the Black Swan, what they're looking at is a Black Swan event is typically characterized as an unpredictable event that is rare, has significant impact, and is hard to prepare for. Now, understanding how to act under conditions of incomplete information is the highest and most urgent human pursuit. So I think that kind of captures, this is part of the book, it's a quote from the book. It really captures what, how hard it is to, be in the market, be in the stock market with incomplete information. We don't know what's going to happen next. Don't have everything for a business. We don't fully know the future. Anything can happen. Now, Common Stocks and Uncommon Profits is another book by Phil Fisher. It's a qualitative guide to finding well-managed companies. I haven't read this yet. I have it at my house. I'm hoping to read it, but I think it does a good summary. From what I've heard, it does a good summary of that, like the qualitative analysis that we do, and it really goes into a lot of companies and how they made how Phil Fisher analyzed those companies and what those companies are like. Now, something to stay away from when you look for books is anyone that has never taken risk before. I'll find people that are actually involved in the stock market and have taken risk before. That's just something important. And from there, I think we're gonna wrap it up. I'm going to share the slideshow so you guys can view that. And that's going to be it. There are some updates coming about what's going to happen after these summer sessions. So I'll talk about that in the Slack. And from there, that's it. Thank you for joining and